All right, when shares of LinkedIn came out at $45 and jumped to $100 a share, the resulting $8 billion valuation spawned talk of a dot-com bubble 2.0. The private investor valuations of Twitter at $8.5 billion, Zynga $9.3 billion, adding more fuel to that argument. But former hedge fund manager Andy Kessler says, enjoy the ride, but buckle up. Co-founder of Velocity Capital Management, author of Eat People, Running Money, a lot of great stuff on the ins and outs of Wall Street and Silicon Valley. Thanks for joining us. So, Fed policy and these IPO valuations, you connect the line directly.
Yeah, well, it's no coincidence when the Fed minutes came out and said interest rates are going to remain low, meaning zero, for months or maybe years. It's this ZIRP, zero interest rate policy. And it's no coincidence that the same day that that came out, LinkedIn went public. They filed at 32 to 35, went out at 45. It traded to 120 and settled in at 90-something. Huge valuation. Why? Well, because the Fed is just printing money in the basement, and it has nowhere else to go. It's gone into gold, it's gone into the stock market, and those markets are getting tired. And
well,
so here's these growth
investors have nowhere else to go either, right? If you want a zero return, buy your Treasury notes, right, or be in that market. If you, on some level, that affects the risk of speculation is not as great.
Cory, a stock is worth nothing more than all its future earnings discounted back today. But in reality, a stock is nothing more than what everyone thinks it's going to earn somewhere out there discounted back today. So with zero interest rates, the discount rate isn't very much, and so you can look out 2 years, 5 years, 10 years, and that's what's happening with these companies. LinkedIn is a great company. All those companies you mentioned are great companies, but their value is based on that future earnings stream.
Well, let me also just stick with the Fed policy notion as well. I mean, if you look back to the bubble of 98, 99 in particular, the Fed was literally printing money like crazy. At that time, concerned about a Y2K crisis, keeping ATMs flowing.
That's right.
But that also is putting a lot of cash in the economy. You put a direct connection between that Fed policy back then and the previous IPO bubbles?
Greenspan took all that money back in after Y2K didn't, send airlines out of the sky and blow up the banking system. It took derivatives to blow up the banking system. But, when did he take the money back? Well, in January, February of 2000. Guess when the dot-com bubble ended? February of 2000. So the same thing's happened today. He's trying to reflate the housing market. It's not working. He should have just let the thing, seek its own price and capitalize the banks, but they didn't do that. So we're going to have this long, drawn-out process of trying to reflate housing. And where does that money go? Instead of into housing or gold or wheat, it's now going into web names.
Well, so let's talk about these tech IPOs, because you've seen a couple of different cycles of this going back to the early 80s, and it was sort of the suppliers of pieces going into computers. What's different this time?
Look, 83 and 84 was cheap chips that created the PC revolution. In 99 and 2000, it was cheap bandwidth that enabled e-commerce, so Amazon and others could come up. Now it's cheap servers and mobile devices that are creating, this low-cost interpersonal communications. And so, it's social networking, all the things that you can do in this cloud environment. They're all real, and there's an economic model to every single one of them. But now we're at a point where expectations are so inflated, or at least
they were really inflated 10 years ago.
Okay, let's
10 years ago, 3% of the world population was on the internet. Today it's 27%. The market's a lot bigger now.
Sure, but we haven't quite harnessed the economic model of that cheap interpersonal communications. Facebook, I don't know, they're going to do $5 billion in sales this year or something like that. It's just getting started. The question is, how far out do you look for value? If interest rates are 5%, you might pay 20 times. You take the inverse of that, you might pay 20 times their earnings. When interest rates are 0.25%, it implies you might pay 400 times earnings. Of course, that's nonsense. What's the real number for interest rates? It's somewhere, but based on inflation, it's somewhere in that 2 to 3% range. At 2 to 3%, LinkedIn's not a $90 stock. It's some lower price, probably still above their IPO range.
There's something about technology that always inspires higher valuations than any other comparable business, because it inspires the imagination. People want to believe that technology is going to change whatever problems they've got. It just seems. You've written a lot about healthcare in the last couple of years, about technology and going into that world. And it's the same thing, right? It's this fantasy of change that can support, among other things, high valuations.
Absolutely. So go back to those previous IPO booms. Look at Amazon. Amazon peaked in 2000. They just last year got back to their peak value in 2000. So if you had bought it at those lofty levels, all the things that Amazon said they were going to do, they've done it and more, right? With Kindles. No, they weren't talking about that back then. But the stock has finally hit. You had to wait 10 years to have it earn. In other words, the duration was 10 years out to break even.
All right. Andy Kessler, author of Eat People, thank you for coming up from the Valley.
Thanks for having me, yeah.
All right, Emily?